Good morning, everybody. This morning we have a very busy schedule, and it gives me great pleasure to invite all of us here from around the world to this amazing conference that is trying to push the frontier of the industry. Even as I introduce the conference to you, and even as I prepare the dialogue that we're going to have, let me make some initial remarks. Let me start by asking you a very important question. Why did Kodak fail? The story of Kodak as being the world's largest distributor of film for many years, and how it struggled in its attempt to follow the digital revolution, is a long story. It's a 40-year story. It's a story where the organization did all that it could to keep pace with the revolution that it was creating itself and trying to dictate and still stay on the top over the years, but it failed. And it's a story that started way back in the 1970s. In fact, if you ask this question, who invented the digital camera? It was Kodak. Who invented digital film? It was Kodak. Who invented the digital bank? It was your bank. Who invented digital finance? It's all your institutions. And yet, something can go wrong. Something can go terribly wrong if we don't understand what it is that is required to take us to where we need to go. If we transpose what Kodak went through to what banks are going through today, it's a very interesting story. Your bank is not going to fail today. Your bank is not going to fail tomorrow. In all likelihood, your bank is not going to fail in the next 10 years. And many of you here who are heads of technology, heads of businesses, and your bosses, the CEOs who are putting in place their respective strategies, they're not going to fail in the time that they're going to be in the profession. Their careers are going to be all right. And yet, that transformation, that revolution that is going to erode the financial services industry as we know it today is slowly taking place. It's slowly coming together. It's slowly being taken out of your feet like a carpet under your feet today. It was in 1994 when Bill Gates first said, banks are dinosaurs. But if you look at the return of investment in banking, with the 2008 crisis being an anomaly, for most parts, many of us come from countries where bank interest rate margins are still good. Banking is still the most profitable industry in your respective countries. So banks didn't become dinosaurs. In fact, they continued to grow, they continued to morph, they continued to absorb the innovations that were being introduced in the industry. And in all likelihood, in the next 10 years, with all the innovation that is being put into finance, in reducing your costs, in scaling your distribution capability, in absorbing the new digital technologies that are coming through, you're going to be successful. And you're going to be successful because the regulator is on your side, because you still gain from the net interest margin business that you're running. You still gain from the FX charges that you're able to pass on to your customers, and they have no clue what the FX costs are to yourselves. You're going to gain because of the payment fees that you charge on everything from credit cards to corporate finance and so on. And yes, you will complain that these margins are thinning, but the competition is still there, and the industry is still being protected by regulators. Yes, there's a capital charge. In as much as it keeps you an expensive business, it keeps others from coming into the industry and competing with you. Yes, there is a requirement for knowing your customers, but that's exactly why many of the new innovations in payments will not take place, because customer payments platforms will still need to go through the banking system. And yes, there is a revolution taking place at the branch level. You're no longer physical. You're becoming more and more mobile, and you will continue to track all of the new channels as they become available. The current priorities in the financial services industry is easy to recognize, and that's why we are here today. We are all undergoing a process of digitization. We are all trying to make sense of what it means to be a financial services business on the cloud. We are all building our networks. We are all setting standards so that we become ubiquitous, so that there is transactions taking place between institutions, between banks and non-banks, in country, outside the country, and on a global basis. You ask any number of consultants, you can look up any number of digitization roadmaps underway. Your institution is probably going through one of those roadmaps yourselves. You know where you are, and you know where you want to be. And many of the mobile-only initiatives that have been taking place in the last 10 years, they've all been absorbed back into the banks. They've learned a few things. They've gone into the market, they've figured out how to scale customers, how to onboard customers very quickly. They've been able to introduce simple products. They've been able to reduce costs. They've been able to increase productivity and service quality. But you've been able to absorb them all back. And many of these standalone mobile banking initiatives, they're all going around and saying, will your bank buy us? When we try to make sense of the evolution that the industry has been going through, and some of you here as CIOs or CTOs, you come from generations when you remember when we were still trying to modularize the industry or modularize technology. And then we started to think a little bit about the integration with business. And then we thought about platform independence. We started creating platforms which were open and which were able to integrate and interact with each other. And then we started looking at the applications themselves and started thinking about service-oriented architectures, and now we talk about service, and we talk about platform as a service, banking as a service, and so on. So what we see happening in the evolution is a greater and greater personalization of the industry. The industry is being taken away from the institution and being handed over by hand to the individual. So the individual is becoming empowered, and the institution is becoming its slave. If we had this meeting 3 years ago, and we did, the conversation, the plead would have been, please give up your core banking systems, transfer them onto the server networks, and do the same thing and be able to scale and integrate with other platforms and so on. Today, we're talking about multiple server platforms. And we're talking about server platforms which have become machines. And we're talking about machines that are starting to talk to each other. And we're starting to talk about machines that are starting to learn from each other. So if you're not part of that journey already, you're late. If you're not part of understanding how all of these technologies are starting to talk to each other, you need to move much quicker than you are right now. When we talk about IoT, we're also talking about the relationships that banks need to refigure out in terms of how you integrate with customers. The customer is not thinking banking anymore. He's thinking lifestyle. He's thinking his own needs. He's thinking traveling. He's thinking leisure, entertainment. And somehow the financial services industry needs to integrate into all of these requirements. There are a few things that we are trying to do which helps us to figure out how we want to integrate with customers. We are putting out APIs. We are saying to the customers, this is what we want to do with you. Can you take a look at it and figure out how you want to interact back with us? But that's not how the customer is thinking. The customer's API is his lifestyle, is how he downloads music or entertainment, how he plans a holiday, how he tries to work out his children's needs, and so on. And then we keep moving, and the agenda is being put on us. We're trying to put out bots in order to be able to speak to the customer at the point that he needs us, and so on. So even as in a technology conference like this, we're talking about all of the infrastructure that needs to be put in place. And in fact, later after my speech, there will be speeches from banks who are putting in place this infrastructure and the journey that they are going through in trying to make sense what needs to be done to get to the customer. The question that should be at the back of our heads is, are we popular with customers? Is the community that we are interacting with interacting back with us? When we create a bot capability on our short messages, are the customers coming back to us and asking us more questions? Are they interacting with us? These are the things that we need to concern ourselves with. But even as we put in place the technology for the future, what banks are not doing is just as important. And this harks us back to why Kodak eventually failed. In as much as Kodak was inventing digital and the future, there were things about itself, about the physical nature of the film business during its time, that it wasn't able to give up. We still think product, product, product. And why we know that? Because when you look at your organizations, the single most important skill set that you have in your organizations are the salespeople. And you have an army of salespeople that cost a lot of money, and every morning your bosses wake up and they start to figure out how to make sales work. A lot of our products are still balance sheet focused. We're still interested in the intermediation business. In other words, that when we look at the payment infrastructure, we're trying to figure out how to keep the bank in the middle of the payment process. We don't understand that today, with an app, the customer doesn't need you. The payer and the payee can just download the apps and interact with each other. They don't need you. When we think about Bitcoin, or when we think about ledgers, we think about ways in which the bank is still in the middle of the transaction, the purveyor, the organization that holds a trade transaction, and so on. We've got very bad habits. We don't give our customers the information they need on their transactions. We give them physical credit cards, which doesn't tell them anything about how much money they have in their bank account, how many times they have transacted, when we could easily do that on a mobile device every time they transact. We engage in price wars with each other as the reason for succeeding in the business. In other words, yes, we invest in so much technology, but at the end of the day, when it comes to winning the mortgage war or to build market share against another bank, it's a price war. We reduce prices. We do not improve technology. We have high cost structures. Banking is still, in many countries, the profession that hires the most expensive people, expensive ordinary people who, if they worked in other places, would not be paid as highly as in banks. We have hierarchical organizational structures. Why do you invest in server technology that breaks down hierarchies and still have matrix reporting structures in your organizations? And we still insist on being profitable. So when will the real beginning of the end be? The real beginning of the end, the phase where in the story of Kodak, the share price went up and then started to disintegrate. Let me try to construct for you the beginning of the end by telling you another story, the story of ice. The ice that you have in the glass that you drink outside of this room. The ice that you have in the refrigerator in your home. That story started in sometime in the 1700s with a man called Frederick Tudor, who in the Boston area had this interesting idea. He looked at the ice that was created in the lakes and he said to himself, why can't I export this ice to other parts of the country? And so he started the ice trade, and he had it exported to New York first, and later he thought I should be able to export it to Havana in Cuba. in the tropics, so that as you export this ice on a boat, a lot of the ice gets lost even as it arrives to Havana. And guess what? He also tried to export it, and he did, to India, because Frederick Tudor's family was what we call a Boston Brahmin, and they had some religious connections to India and to the UK and so on. Can you imagine this crazy idea of exporting ice? And the railway companies and the shipping companies that took the ice that he was exporting on board laughed at him and said, "You think this thing will survive?" But in that process, slowly, other people started to think about how to make that ice survive a long journey. So we started to have thermos technology, sawdust, and other things in order to keep that ice alive as long as possible. And over time, high society in New York, in London, loved the idea of having ice in their gin and tonic, and ice in their Bacardi rum in Havana. And it became a social status symbol, and ice had a value. And with that value came the investment in the technology, in thermos, and eventually into the manufacturing of ice. And at the height of the ice industry were the ice merchants. All of you in the financial services industry today, you're the ice merchants of the finance industry. If you're a bank, you're an ice merchant. You're the wholesaler that tries to put together the industry and make it available to the man on the street. Then came the real revolution, and that real revolution is a scientific technology called chlorofluorocarbons, or CFCs. CFCs are synthetic chemicals that absorbs heat. And when it does that, it enables the environment outside to cool down. They use that in refrigerators, and they use that in air conditioning and for a long time. And of course, today we know that chlorofluorocarbons are also dangerous to the ozone, and so they've started to look for alternative technologies. But because of CFCs, ice became highly personalized. It became a technology that became available in your kitchen. It became available in your living room. It became tamed. It became something that you did not even think about in your daily life. So what will the banking industry's chlorofluorocarbon be? Actually, there's a lot of work undergoing right now to discover that chlorofluorocarbon in banking today. What are that work? There are peer-to-peer players that are trying to get credit to the lowest customer, to the poorest customer in as cheap as manner as possible. The credit scoring models that we have, which are like the ice merchants, which makes credit expensive and available only to a few people, that's being disintegrated because with a lot more information and a lot more intimacy with the customer, you can actually make small amounts of credit available to a larger amount of people around the world. In payments, today, there's a lot more infrastructure that makes it more transparent and quicker, and where you can make quick, small payments as quickly as possible. You know, the interesting thing about the demise of, or the eventual bankruptcy of Kodak is not that it didn't invent the digital camera, or it didn't invent the digital film. Actually, these things were invented in the 1980s. It gave them a long time to make that transition into the new world. The funny thing is that from the year 2000, a few things happened. Even as digital was being invented, digital was being networked. In other words, people were able to share data at the back end of the digital film industry. And digital was becoming personalized. You didn't need to carry a camera. In 2007, when the iPhone was created, it just increased the quality of digital and made the camera completely unnecessary. And so it was lifestyle, it was networking, it was personalization. Those were the elements that made digital technology revolutionized the film industry that eventually killed Kodak. It was not the product. It was not the product itself. And yet, when you look at every bank's website today, you see product, you see product, you see product, you see product. All we are concerned about is the product that we sell. We are not concerned about the intimacy, about the interaction, about what it is that we're learning about the customers. And think about the organizations that are making a difference today, the organizations that are truly revolutionizing finance. Think about WeChat. When WeChat introduced the WeChat Red Packet, the Hongbao, they didn't introduce it because it was a product. They introduced it because within WeChat, there were people who were trying to send red packets to each other on Chinese New Year's Day, but thought that, to send so many red packets was so difficult. And so, as a fun exercise, they said, can we do this electronically? And they did that electronically. They did that because it was fun, because it was something that they would do otherwise anyway. And when they released it into the market, the first year they had 1 million red packets. And in the second year, it just took off, and today it's in the billions. And other companies like WeChat have stories similar to that. Alibaba talks about how by matching their customers with each other, the customers is asking, why can't we have payment platforms that helps us to complete the transactions on our own? Why can't we keep an escrow account where we can invest the money that we are still waiting on as a float, and so on? So you see, the thing that we need to internalize is how is all this technology making us closer to our customers? Jeff Bezos, the founder of Amazon, at about the same time that Bill Gates said that banks will become dinosaurs, said there are two types of companies: those that try to charge more and those who try to charge less. We are the company that wants to charge less. He also said, your margin is my opportunity, meaning that if you're making a profit, my job is to figure out how to destroy it. And yet, in the banking industry, our margins are our love babies. We're not giving it away. We need to keep talking to the regulator to make sure that we keep our margins. And he noticed something, that banks actually sell second mortgages so that people with very stable homes will actually give up those homes just to get cash and go on a holiday. And he says that's approaching evil. And that's why this industry gets the bad reputation that it does today. We are so product-centric. We're selling what we want to sell to the customers. We're not asking what it is that makes us a part of the customer's life. Did you stop to see how the customer's financial profile has changed over the years? In 1990, an average wealthy customer asset composition, a lot of it would comprise of a physical house. That would be his single most important asset. By the year 2010, a lot of the assets had moved to become more ephemeral, meaning not property itself, but shares, but alternative finance, art, lifestyle, and so on. In other words, people are valuing less of the physical wealth and valuing more of the things that are important to them. By the time we get to 2030, many of us here will not want to own a car because it's stupid. You can just go downstairs and you can hire a driverless Mercedes or a low-end car, depending on what you want to be able to pay and how fast you want to get to where you want to, without even worrying about owning that transport. And the idea that a car sits in the garage for 6 hours a day is unacceptable in many of our minds by the time we get to that era. And in that way, there are many things that we may not want to own. Even today, some of us would value our ability to travel well on first class rather than sit at home and maybe buy new furniture, because traveling is much more an expression of our wealth than having a large number of furniture at home, and things like that. And so the value of the next generation is changing with all that technology is making available to them. In your respective banks and in the conversations that we're going to have afterwards, we're going to be talking about things like retention costs. We're going to be talking about cross-sell ratios. We're going to be talking about customer-level profitability. But I need to caution you this, that the reason for these conversations is the result of succeeding with customers. It's not the cost of building relationship with customers. Don't think like an ice merchant. Think like a refrigerator. And so the finance industry's chlorofluorocarbon eventually will be an industry which empowers the customer, that personalizes to the customer, that makes the customer, makes finance a part of his everyday life. So is your bank working to avoid its own Kodak moment? It's a question that we want to keep at the back of our heads as we get into the rest of this day's conversation. I wanted to start this meeting with these points so that we remember where we are in this journey to digitization, that we remember the end goal that we need to reach eventually, that is authenticity with customers, that is integration with the customer's lifestyle, that is listening to the customers, and creating products that demonstrates that we actually derive them from what the customer wants. Because the new players that are making this a reality are showing us that it is possible. In this country, the non-banks had built the payment infrastructure to $600 billion before the banks even realized that it was possible. In other countries, in Africa, in other parts of Asia, non-banks, the payment companies, the supply chain companies are creating huge flows that do not at this moment affect the banking industry. But eventually, the banks come back and say, oh my goodness, there's a huge business that we had missed out, and now we're trying to reintegrate too. When we think about WeChat, when we think about Alipay in China, that's exactly what we are thinking about today. So with these initial comments, it gives me great pleasure to welcome all of you here.